Other thing is the other asset classes are not as lucrative as they used to be earlier. So real estate used to make you 15-20%. Fixed income used to give you 12-15% return. Now, those are also giving you 4-5% return. So I think investors are okay with equity giving you, decent double-digit returns. They are not looking at 40-50% return, 30-40% return, which they used to be. Now, we are guiding that maybe next 3-4 years equities would be more like low to mid-teen, and investors are pretty okay. The other thing is this whole concept of professional family offices have helped. I think all the wealthy guys have kids or themselves who are now well educated. They understand this whole concept of long-term investing. And I think that has actually sunk in. And that is the reason we are seeing come whatever the news flow, whether it's India-Pak war or whatever, the SIP investments continue. Investors generally have been pretty much very clear that they want to invest to create wealth over a period of time. And I think that also has helped. And obviously, chats like this, media, I think that has all helped because this awareness of what investing is all about is now more clear. Earlier, equity was all about speculation, satta. But now it is, now investors realize that it is, there's a science and art and hard work which goes into investing.
Yeah, I remember a time where people did call it sattebazi, and they were like, whatever money you put in the stock markets, you burn it,
Right.
because there was such a negative perception to now this mindset of like long-term wealth creation, which is coming. But you said something very interesting that, you are not seeing that high returns for the next few years, and people are okay with that. Can you educate our audience in terms of why you expect the returns to be lower than what we've seen?
So see, one thing is inflation is bad for the economy, but good for corporate profits. So earlier when you were looking at a 15-18% profit growth, I think 6-7% of that was being contributed by inflation. Because when inflation goes up, your sales growth automatically goes up. So even if you sell the same number of soaps, if the price of the soap goes up by 10%, you'll have a 10% growth. I think that has come down to 2-3%. Second is we are not as cheap as we used to be earlier. Earlier 10-12 PE was what most of the stocks used to trade. Now nothing is below 18-20 PE. Obviously because interest rates have come down, economy is much more resilient, larger, and therefore, this whole stability has come in. Third is obviously, the alternates like fixed income. As I mentioned earlier, 11-12% was what you could easily make in fixed income. Fixed deposit rates were 9-10%. They have all come down to 4-5-6% post-tax, is 4% in fact. So obviously, if you have one asset class giving you 4-5%, the other asset class, because you're taking that volatility risk, will be slightly higher. It cannot be significantly higher. The last thing is investors are also now looking at post-tax returns. So when you have 35-39% tax on your other income generating investments, and on equity, long term is 12.5% with surcharge, maybe 14-15%. I think they also take that into account. So post tax, even at 12-15% returns, you are 3x of your fixed income returns. So I think all put together, I think investors have realized that this compounding, even if you grow at 14-15%, your money doubles in 5 years. I think no asset class is going to double your money in 5 years. So I think that there is a big, awareness.